Are stocks just going to ignore the negativity, or have they already absorbed it and are going to go up anyway? Welcome to Macro Money. This is Ilya Spivak, head of Global Macro here at tastylive. As ever, we are looking down into a complicated story here around the financial markets. So if you're watching this on YouTube, jump into the comments, share your thoughts. What do you think about the geopolitics of the current situation? Difficult as they are for markets to digest. What do you think about the situation with stocks and the Fed and rates and currencies? And needless to say, keep it cordial, and we'll include the comments into what we cover here on the show. The focus for this week will be to ask of the various event risk that is going to cross the wires, have the markets run out of negativity? It seems as though we have a kind of sum of all fears situation developing, whereby we have the three main engines of global growth in various state of disrepair. Europe arguably already in recession, China and the latest data out of there looking increasingly anemic, and the U.S. very much under the thumb of the Federal Reserve that insists it will keep interest rates higher for longer to beat inflation at a time when, of course, these global growth concerns have investors pining for a reversal, not for a delay of rate cuts, but of the soonest possible transition into some sort of an easing cycle. On top of this, of course, we have the horrific situation now taking shape in the Middle East, and the possibility that it spills out into a broader conflict with bigger powers and perhaps even with interested parties that overlap with the conflict already ongoing when this next theater opened up in the Ukraine. So we seemingly have reached a kind of fever pitch of negativity. And of course, for us as traders, because that's the hat that we're wearing here, the question, as ever, when analyzing forward-looking markets is, have we reached all of the negativity that needed to be baked into asset values? And does that then mean that the capacity to go down, unless the news gets markedly worse, already exhausted? That is, are we out of reasons to fall in financial markets, at least for now? In looking at this, we begin our story with the first bit of macro event risk for the week, and admittedly, there isn't much of it. The U.S. retail sales report. Now, this can be quite a volatile series, as you can see on the screen here, but there's actually much more that is meaningful here than meets the eye. So the expectation is that we're going to see a bit of a climb down. Last month, we had an impressive looking 0.6% increase. That was a much stronger outcome than the 0.1% that was expected by investors, which is interesting in and of itself. The outcome due for September looks for a halving of that to an increase of 0.3%. Now, why is the 0.6% so interesting? Because something like 0.4% of that comes from gasoline. The actual increase in retail sales, excluding a rise in the price of gas, was a meager 0.2%. So once everything else is netted out here, you can see we have some negative contributions, for example, from sporting goods or from furniture, positive contributions from motor vehicles and food and clothing. Once you net all of that out, you get an increase of 0.2% or so while gasoline, largely for reasons having to do with OPEC and Saudi Arabia in particular, threatening to cut output, seems to be higher just because more dollars are going toward that kind of spending, or did in August, which, as you can see here, shaded the outcome to be much stronger at the surface level, or at least look much stronger at the surface level, than underlying spending would suggest. This is, of course, critically important because the markets are ever looking at this information to guide their Fed policy outlook. We saw this in spades last week when we had the University of Michigan consumer confidence numbers come out just this past Friday. They rattled stocks. Now, they certainly showed a meaningful decline in consumer sentiment, but more importantly, even than that, they showed a jump in inflation expectations, which is a different sort of dynamic than what we've seen in recent months, and seems to mainly reflect that the decline in consumer sentiment echoes higher gasoline. That would, of course, comport with what this is. Now, interestingly, gasoline, along with crude oil, have sort of leveled out and started to head lower. And so as we look at what is truly the nature of the U.S. consumer, it is perhaps logical that we should see shading to the downside in this retail sales report from now lower gasoline than we saw in the earlier report. But at this stage, it is what happens with that core group outside that matters, because it is that which will reflect more accurately the health of U.S. consumers and therefore the U.S. economy, because, of course, in the U.S., over 70% of GDP growth is accounted for by household consumption. This is very relevant for the Fed because, of course, this echoes to a large extent what we saw in the CPI report last week, the other worrying bit for markets. When that CPI report came out just a little bit warmer than expected, we ended up with a panicked response from markets. Bonds fell as yields rose and stocks retreated, ostensibly around the idea that with inflation higher, the Fed is not going to give us rate cuts on any kind of near-term timeline, that it's going to delay the aid that markets worried about this gathering global recession and all these various other risks so desperately want. But this is where things get interesting. So have a look at the makeup of the last CPI report, and you find that while headline was a touch higher, 0.04% higher, as a matter of fact, the difference was from 3.66 to 3.7, right here. Just a touch higher from the prior month, August to September. Core, which of course includes this whole structure here, so not food in the green, not energy in the yellow, and of course tilted towards services, the part of the equation that the Fed most cares about, because this is where the labor market has locked in inflation. On that score, inflation actually ticked down 0.2%. What's more, we can see the most significant contribution to inflation over the course of September was energy. And energy is still a negative contribution overall. So the entire story really was about energy becoming less negative, less of a drag on inflation. Meanwhile, services, the part that the Fed cares most about, was a dramatic shaving of inflationary influence, nearly a percentage point. In fact, if we look at the internals here, we can see that all of what the Fed cares about seems to actually ticked down. In particular, this shelter component seems to have eased a bit. The transportation component seems to have eased a bit. And both of them have been the leading contributors to service side inflation. So what we are ostensibly seeing here is the kind of thing where the market looks at the headline number and says, well, the Fed, looking at this stronger inflation, might hold rates longer than we thought at these elevated levels. But actually, the kind of inflation that we see really speaks more to this crude oil influence becoming less negative than really anything the Fed can either control or that it has targeted. If the mission for Federal Reserve policymakers is to bring down inflation lodged in core services here, the main remaining component that we can see, well, then all of those things moved in the Fed's favor. They moved in the Fed's direction. And so with that in mind, the market's response to the CPI report seems to be a little bit knee-jerk. Now, when we look at retail sales in this context, again, going back to what happened in August, if what occurs this go-round is the decline is meaningfully shaved by crude oil and gasoline, but once we take that out of the equation, the underlying continues to look soft or even softer, provided it's not terribly catastrophic. Then the thinking process may not only be, well, this suggests the Fed is in no position to delay easing because the engine that is the main driver of the U.S. economy is sputtering, but for cosmetics in the oil market, making it appear as though retail sales are stronger than they are. But that this also helps to illustrate why the CPI report was the way it was, and really highlights the same basic idea that it isn't that the economy has developed more demand and so retail sales are up. It's that actually demand, if we look at core inflation here as a measure of what happens if demand is easing, right? Things go on discount. If people don't buy things and things don't sell, they are discounted, so the price comes down. For this reason, economic activity and prices typically go hand in hand. A pickup in economic activity typically boosts prices, as a slowdown in economic activity typically reduces them. If what we're looking at then here is in fact going to inspire people to rethink the implications of the CPI report as well, and what's actually occurring, because indeed these are two sides of the same coin, then these fears that animated markets last week may well begin to recede. Be they linked to the consumer sentiment report or the CPI one. And this is where things get really interesting, because in the end, as this story winds up toward the latter part of the week, we are going to get a very important speech from Fed Chair Jerome Powell. He's going to be speaking at the Economic Club of New York. And these speeches are oftentimes kind of inter-meeting and inter-official announcement opportunities for the Fed Chair to shape forward guidance. And we've seen already, out of a whole host of policymakers other than the chair himself, that more and more voices on the policy setting FOMC committee are starting to endorse the idea that in fact July was the last rate hike and the Fed is about ready to think in the opposite direction. We can see here that looking at the yield curve as it presents itself for the implied policy rate at the moment, we're currently at about a 5.4 rate. The expectation is we're going to sit at this 5.4 rate for basically the next 6 months. So we can see here the markets are not baking in any more tightening. The likelihood that anything else occurs, very, very low here, clearly, as we go from 5.38 to 5.4 to 5.48 to 5.41. We're essentially up or down a handful of basis points either way, but certainly no 25 basis point move is being baked into here one way or another. And from there, the market anticipates that over the subsequent 6 months, there is easing. And what we see here is a climb down of just about 50 basis points between 5.4 and 4.9 through the end of next year. So right about where we are currently in 2024. Now, if the Fed chair comes out and essentially endorses this idea, if what we've seen over recent announcements from other policymakers essentially amounted to a sort of series of trial balloons to put forward this idea, which the Fed has not endorsed itself yet, but which the markets are already baking in, if we look at expectations here, that in fact the Fed is on board with the idea that rate hikes are probably over, that it's not truly meeting to meeting, we start from scratch every time, because the general consensus on the committee has moved toward it's time to stop hiking, rates are as high as they need to be to achieve our goals, well then markets will get a powerful relief of the kind of fears that animated them last week. Even as we can see, the actual calculus for what's baked into policy rates hasn't materially changed. There's a mere 7.8% chance of a hike at November's meeting. It's a little bit higher at about 30% for December, but that's still quite low. Cumulatively here before the end of the year, the probability of an increase is a mere 0.37, which translates into 37%. That's, needless to say, implying a much more commanding probability that rates don't change from here. We see the first cut fully baked in by the time we get to July. So not surprisingly, we saw here 6 months forward from October is where we are expecting standstill, and the easing comes thereafter. Well, 6 months forward from now lands us just before the middle of next year. And as we can see here in June, the probability starts getting significant at 66%. The cut is fully baked in by the time we get to July right here, with a slight 15% chance of a further decline. That second easing, that second cut, where we go from 25 to 50 basis points, that occurs fully in the market's reckoning no later than November of next year. And then come December, there's a 67% chance of a third cut. Now, as we can see here we are in October, and the next Fed meeting is early November here. So essentially in this year, from here to here, we now see a difference of 50 basis points. So here's the current implied rate of about 5.35. Here is the 4.8 that's implied for November. And of course, that is another 50 basis point difference, much as we saw right here in this way of looking at the market. So as we look at various things, various corners of the market where interest rate expectations live, we can see the forecast has relatively settled. And from here, if the Fed endorses this, or at least if Chair Powell, for the first time in a while, really gives a more balanced perspective rather than the sort of higher for longer leaning inflation is our primary concern narrative that he's been echoing in recent weeks and months. Then the markets would get a reason to feel cheerful, perhaps even with all of the various other worries out there. In between these releases, in between the retail sales and the Powell speech, we're going to get Chinese GDP numbers. And here we're expecting to climb down from the 6.3% year-on-year growth rate recorded in the second quarter down to 4.5%. Now, there was a climb down from the second quarter to the third is pretty well documented at this point. Here are official Chinese PMI numbers. These are from Beijing itself, and we can see here is the first quarter, here's the second, here's the third. And as we can see here, whatever's going on here, even though it's trending down, the actual levels of growth that we see here at around mid-year are clearly higher than what we're seeing here, even if we just look at the composite gauge. It's very similar if you look at the private sector estimate of Chinese PMI, and you see that it also, although it's a little bit different from the official numbers and arguably more dire, telling you the same sort of picture. The overall setting for growth at mid-year is here, and it has since deteriorated here. And so you can see that indeed it does look like China's economy slowed in the third quarter. We just saw disappointing inflation numbers over the course of last week, showing us indeed the extent to which demand is anemic. And we can see as of the second quarter, the numbers preceding this release, we actually had the very unusual situation that real GDP surpassed nominal GDP, which implies a 1.5% deflationary gap between the two, implying a virtual absence of demand. As we said, the price for things goes up when there's demand for those things, and buyers compete because they want to get their hands on some amount of scarce supply. The stronger the growth, the stronger the demand, the more the price goes up, because the slower the supply is to catch up to where the demand is, if it's that rapid. So if economic growth is quick, you get inflation. On the other hand, if the economy is going significantly in the opposite direction and there's no demand, or demand is actually shrinking, well, then you end up with things going on discount, because then there are more sellers than there are buyers. And so the price comes down. What we see here is at the economy-wide level, there's a 1.5% deflationary wedge here between real and nominal GDP. And that, of course, speaks to an awful set of conditions for economic demand in China. The question, though, is, if we know this already, if the PMIs have amply shown it, if the second quarter GDP numbers have shown it, is there anything here that the markets have not already baked into asset values, or have all the bad things about this situation already entered into markets, considering China has been unable to get back on its feet now for nearly a year since scrapping COVID restrictions toward the end of last year in December? Well, if we look at the dynamics for how economic data has performed relative to expectations, it's still narrowly negative on the Citi Economic Surprise Index for China, implying that economic data still tends to underperform relative to forecasts. However, what we see here is that it has meaningfully shifted to a less negative reading as of the middle of July. Now, this is not necessarily good news if you're the Chinese economy. because ostensibly the reason why this index has shifted isn't because the data has gotten better. It's because expectations have gotten worse. So the bar has been lowered. Economic data now has an easier time of registering closer to expectations, less worse, if you will, because right from about the second half of July here, we can see, according to this Bloomberg survey of GDP expectations, that the outlook on Chinese economic activity has deteriorated from exactly that time. You can see the index bottoms in mid-July. In the second half of July is when we get this revision. So that the data has gotten better relative to expectations nominally isn't necessarily good news for China's economy. But it might mean that investors have already priced in the negativity that there is to price in. And in fact, this was the act of doing so, lowering these expectations. And if that's the case, well, then as long as Chinese economic data doesn't come out terribly worse than expected, there might not be any further negativity here to drive markets in any kind of a sustainable way because expectations have already been cut. So we end up left in this interesting space whereby if the retail sales and the Fed's numbers seem to suggest, or the numbers that the Fed cares about seems to suggest that market worries that have so animated them about interest rates holding higher for longer are already absorbed to the extent that those worries still develop. If in fact it looks like the data, at least the data that the Fed cares about, is already endorsing a pause, and then Powell confirms toward the end of the week that this is where the thinking is heading, and at the same time, the situation on the economic cycle front, most critically coming from China here, as well as the U.S. retail sales numbers, if that seems to suggest that what we have isn't meaningfully worse than what we already expect and what we've already discounted, well, then perhaps stocks are out of reasons to fall. Perhaps bonds are out of reasons to fall. And what we might be looking at in the coming week or weeks is a kind of climb up along the wall of worry where nothing gets necessarily better. The world still continues to flirt with global recession. We continue to have an absolute nightmare on the geopolitical front. But if the markets are out of reasons to sell anew, then they might be out of reasons to keep going lower. Now, this, of course, does not mean that we wouldn't get necessarily some sort of very off-putting escalation on the risk front or some sort of additional stress in the credit space. All of these remain live risks. But if, in fact, the current sum of the known fears has already been absorbed into asset markets, stocks may be ready to climb that wall of worry after all. Whereas the US dollar might be in for a bit of a correction low. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio, head of Futures and Forex here at Tasty Live, and increasingly Dylan Radigan as well, where we look at the day's events in markets and try to figure out where they might be going next. I'm also on with Tom and Tony Sundays for First Call, on with Chris again on Fridays for Futures Power Hour, opining for the news and insights section of tastylive.com. As a matter of fact, this very analysis is there in summary already. And commenting every now and again on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining, everybody. See you tomorrow.